Okay, there we go. All right, so welcome everyone. Good morning or good afternoon or good evening, depending on where you are. And welcome to Trading Coach's Playbook. Welcome back, Brenda. Welcome everyone. We'll go ahead and kick this off with a quick reminder before we get started that we are not broker-dealers or investment advisors. When we look at the markets, we're looking at them from an educational standpoint only, and we're not giving any personalized recommendations or telling you to buy, sell, or hold a particular securities. All markets are subject to loss and risk. And all we can do is minimize the risk. We can never eliminate it completely. And we are also not subject to trading restrictions. We got positions in securities, initiate them at any time. Lucy is sitting in her dog pillow off to my right now, and Pascal just left the room. So the dogs are around, and I just took my ducks outside. So, oh, actually, as soon as I mentioned her name, of course, here she is. Yeah, here's Lucy. Hey, Lulu. Hi guys, how you doing, Alex? How you doing, Kevin? Okay, Lucy. Okay. There you go. Go relax. It's time for you to work a little bit. Anyway, so welcome everybody. Obviously, we keep a pretty busy calendar going on here. One of the main things I'm involved in is every Monday, Wednesday, and Thursday from 9 a.m. to 11 a.m. is the E-mini Think Tank. Love to have you join me there. If you're interested in doing that, you can do it for free. Check it out. We do a free 2-week trial if you do a quarterly subscription, and you get full access to everything. And the reason why I bring that up is I'm going to be referring to some of the education that I talk about in that class. Basically, with the E-mini Think Tank, it's also it's live, obviously, for those 2 hours, 3 times a week, so 6 hours a week, where we basically exercise and practice what we've learned about the markets. And one of the things in the E-mini Think Tank that you learn, first of all, there's foundational trainings, and it's all documented as to kind of the order that you should be viewing these things. And what happens is I basically teach what I've been doing in analyzing the markets. And one of the things we're going to talk about today is gaps and kind of the psychology of what's going on behind the scenes, what causes the gaps, why are there gaps. Now, E-mini Think Tank obviously focuses on futures, but the same techniques, all of this charting technique can be applied to equities, Forex. It doesn't really matter because when you're trading and charting, you're charting people's perceptions of securities. You're not actually charting the security itself necessarily. If I go out to a chart, and by the way, that's all pre-recorded on-demand education. You can view it as many times as you need to over and over again. And there's documentation that backs it up as well. So again, with the charting techniques, all that stuff is there for the documentation that supports the education, which is pretty cool. It's a program that I inherited and kind of took over and ran with it. And yeah, hopefully, like I said, if you're interested, you can check it out. There's the link there. And basically, where am I going here? I wanted to go to my browser. I've got too many things open, I think. I was trading just a while ago as well. There we go. And we'll do this. So there we go. And what I'm going to do, I'll just go to, actually, I'll go to QQQ. It doesn't really matter which security I look at, but right here, I'm on QQQ. And basically, what we're going to talk about today is a little bit about gaps. And basically, the gaps occur in equities primarily because you have regular trading hours and you have extended trading hours, and then you have a shutdown period where the markets are physically not tradable or not open. Well, there are other markets, even that are open on a regular basis, that actually do have gaps, but they're kind of artificial gaps at this point. So, for instance, if I go out to barchart.com and take a look at the contract specifications for futures, you wouldn't expect futures to have gaps because they trade nearly 24 hours a day. But when you take a look at something like the energy market, for instance, what you'll notice is there is the trading hours, or there are the trading hours listed right here, 5 to 4 p.m. Central Time. However, here it says RTH. There's another little section there. RTH are regular trading hours. So what happens if you want to see gaps in securities that typically trade 24 hours a day? Basically, you can exclude everything but the regular trading hours, and that's your gap. Between 2:30 Eastern to 8 or 9 a.m. the next morning, any activity that goes on is extended trading hours. So you can actually exclude that, highlight it, whatever you want to do. And then you'll actually see gaps in futures where you wouldn't normally see those. As a matter of fact, let me bring up a tasty, or not, sorry, Thinkorswim. And real quick, Alex, I'll get to that in a moment. I want to stick with the topic right now, but I can answer that a little bit later. Interesting. Okay, I'll take a look at that video. What happened there? And no, actually, I can answer the recommended risk reward ratio for the SPX options that I do would be at 105, not 70 cents, because that'll basically, if you were to take in 35 cents in premium on an option trade and you exit at $1.05, then you would be losing 70 cents. And that's the goal, is to lose no more than twice what you are gaining in potential profit. So if you get exit at 70, then you'd only lose 35 cents, because you remember, you collected premium, you have to pay to get out. So you need to pay 3 times, because that would exit minus the premium you already collected at a 2-time loss, if that makes sense. And let me just log in real quick. There we go. Oh, really? Okay, fine. Send me a text. It's kind of weird. Oh, it's because I have my VPN on. I forgot. It doesn't like the VPN sometimes. Yeah. Oh, okay. Cool. So anyway, I'm going to open this up, and basically, like I said, we're going to talk a bit about gaps. I can show you on multiple securities, multiple charting platforms. It really doesn't matter. So, like I said, but in order to see it in futures, you have to look at the markets a little bit differently. So, I wonder if I can do it here. For instance, if I go into ESH 2026, that is the S&P futures, you can see that on a 1-hour chart, we've got trading going on nearly 24 hours a day, right? And if I go to a 15-minute chart, even more trading activity. However, if I change this a little bit and say, okay, we're going to see electronic trading hours. However, maybe we change this a little bit and put in some shading. See if that works. Maybe that's not where I need to do it. I forget where it is. Canvas, no. Thought there was a way to highlight the background for regular trading hours only. Symbol hidden, high, low, bid ask. Okay, where the heck is it? No, I've done it before. That's why I was trying to bring up my other platform, because I know where it is much faster, because I don't do it as much on this one. Oh, well. Oh, no, it is shaded now. Okay, there it is. Sorry, I didn't realize I did it. So right here, you can see between 4 p.m. Eastern and the next morning at 9:30, that's extended or electronic trading hours after hours. So in a way, this stock, or not stock, but this future actually did gap, even though physically it didn't gap. If we change the hours that we're viewing, and again, just focus on regular trading hours only. Let me darken that shading. There we go. That's a little better, actually. That's what it was. I couldn't see it. Now we could see that we actually had a close, previous day's close right here, 4 p.m. Current open today, 9:30 a.m. So we actually did have a gap up. If we take a look, as I mentioned before, CLJ 26, oops, for crude oil. Actually, now I'm going to close out of the platform because I don't want to have too many things open here. Now it should, and see, this is where it makes it, you need to make the adjustment, because electronic trading hours for crude oil are not 4 p.m. to 9:30. That officially opens at 9 a.m. and officially closes at 2:30 p.m. Okay, we just saw that right here. Regular trading hours, 8 a.m. to 1:30 Central, 9 to 2:30 Eastern. So the gap here, if there is one, would be the 2:30 close to the 9 a.m. open. Sorry, it's 9:30, 9 a.m. right there. So it's shaded off, unfortunately, because the program doesn't recognize the electronic trading hours different for the different securities. And there's other securities that do this as well. Obviously, the indices, we can use the 9:30 to 4 Eastern regular trading hours, even though it doesn't list them here. And there are some others. You go to metals, you'll see regular trading hours for gold, 8:20 a.m. Eastern to 1:30 p.m. Eastern. This is always showing Central Time. So that's how you create kind of synthetic gaps that you wouldn't normally see. And like I said before, primarily when we're focusing on gaps, we're usually looking at trading stocks. So if we were looking at a stock like Tesla, okay, now it's removing my after hours trading because it's not showing it at all. And we see the gaps much more clearly here. But there's actually a reason behind the way gaps are created, not only a reason why they're created, but there's a way to trade them. And that's what I did in the E-mini think tank this past week is we started off on a lesson and creating a trading plan on how to take advantage of these gaps, which is kind of interesting. So you'll see that I actually started talking about it. Let me see, where's the picture I had? Again, I got too many things open right here. Let me find the right picture. There we are. Gaps. We were focusing on, I think it was, NASDAQ at the time. And what happened was you can see a prior close and the next open. And I had actually removed the trading between 4:15 until 9:30. So we were only looking at regular trading hours. And what happens, and you'll see it, let me go here to the NASDAQ NQH 2026. And I'm on a 15-minute time frame. And we could take that other day as an example, or even today, it doesn't matter. But what'll happen when you're looking at these markets is typically go into volume, add that. In the overnight, these are US based securities because they're in a US based market. So we don't see a whole lot of volume after hours. The majority of the volume is traded between the regular trading hours of 9:30 to 4 p.m. Eastern. But it doesn't mean there isn't trading going on. Now, here's the thing you have to realize about the markets. If you want to be successful at pretty much anything in life, you want to find somebody who is very successful at what that is that you're trying to accomplish and most likely copy them. You try to mimic a lot of what they're doing so that way you could have a lot of the successes that they've been having. Obviously, you try to follow what's been working. Well, when we take a look at what's been working for the most part in the equity markets and who's making the most amount of money, we have something called market makers. So, for instance, if I go to NASDAQtrader.com, right here, I can put in, we'll go Tesla stock. And right here now, as I look at Tesla, whoops, it didn't go. Give me a lot of different securities. There we go. Tesla common stock. That's NASDAQ listed securities. But what I was trying to find is daily MP market participant. So actually, this is where I'm going to go instead. And you see, is it going to show view? There we go. For the stock Tesla, you have 46 market participants every single day. Okay. Got my attention when I said Tesla. There you go, Roman. So what does this mean? What is a market participant? Well, my history, I'll just go back a little bit, not too much about me, but I worked for a brokerage called Lloyd Wade Securities. I'm not sure if they're a market maker here. I doubt it. But what we did, I was a trader for the brokerage. So basically, the market makers, the name kind of suggests market maker, and that's what MP type happens to be. See the M right there means market maker. There's other ones, NR, that's something different. And I'm not going to look up the legend right this moment because it doesn't matter. But actually, there's definitions anyway, I think. Let's see. Yep. NR non-registered, order entry only, or M, registered market maker. Okay. So what the heck does that mean? Let's hit Control X. There we go. There you are. Market maker or non-registered order entry only. That's what I was. I was order entry only. So what happens is basically these market makers, based on the name, they make markets. They create liquidity. When you look at a security, you've got buying and selling going on all day long in that particular stock. Some of those orders are coming exterior from from brokerages, from mutual funds, from individuals like you and I trading, and those orders get sent into the exchange. Well, it used to be like in New York, and in Chicago, you had people on the floor of the exchange who were tasked with creating liquidity. They were called specialists. And the specialists would basically stand in the middle of a pit and get screamed at all day. And their job was to direct traffic. They were directing buyers and sellers and matching them up and creating trades. If nobody wanted to buy and there's a bunch of selling going on, they had to become the buyer, and vice versa. If people were wanting to uh, sell or buy and nobody was wanting to sell, they became the seller. Okay, they were creating liquidity. This in the electronic markets like the NASDAQ, this never had a physical exchange. The NASDAQ, most people don't know, but it's not in New York City. Okay, most people think, oh yeah, I see it in Times Square, the big signs and the building and everything. Nah, there's nothing there. That's just a storefront for the NASDAQ. The real NASDAQ is a bank of computers in Fox River, New Jersey. Okay. So what happens is these particular brokerages, and most of them are brokerages, TD Securities, Cantor Fitzgerald, um, Baird and Company, all those different ones out there. StoneX, some of you might actually trade through StoneX, Barclays, and whatever. Anyway, what happens is these brokers or brokerages have paid the NASDAQ to become what are called market makers, and they have agreed to create liquidity in the market. They are always willing to buy and always willing to sell. And you'll see this if you look at what's called market depth, which I'm not sure if I have access to right this moment. Um, I don't have to turn on my trading and everything. I'm not doing that right now. But yeah, when you look at market depth or level two, you'll actually see trading going on at different price levels. Again, if you are a market maker, when the market opens between 9:30 in the morning Eastern and 4 p.m., you are required to be on both the bid and the ask for your securities at all times. If you're absent for more than I can't remember what the time limit is, but you get fined. So they're there to create liquidity. Now, they're also there to make money. As I mentioned, they pay the exchange to make money, basically to become a market maker, right? They pay for that right. You got big one right there, Goldman Sachs. And if you look at your market depth, if you have level two access, you'll actually see this. It's not necessary to have the level two access, but you'll actually see this. Um, so anyway, they're creating liquidity. So what they're trying to do is obviously make money for the brokerage, but also get their customer orders filled. And this is what happens first thing in the morning. Oh, I was in the right spot. There we go. Again, if I go to Tesla as an example, and then like I said, I can use any kind of security for this. But when you go to Tesla, for instance, let's see, today, it doesn't matter which day. We can use this particular day here. This is the 10th, Tuesday. Okay. At the end of the day, Tuesday, 4 p.m., market shuts down. And just a little bit after that, everything for the most part shuts down for the day. There's no more trading going on. The market makers go home and, they're mainly in Jersey City, New Jersey, because they're across the river from the exchange. We're on the same side of the river for the NASDAQ, but a lot of the market making activity happens to be in Jersey City, New Jersey for whatever reason. And basically, when all the order stuff is done at the end of the day, they just close up shop and head home. However, their day starts at roughly 8 a.m., not 9:30. So now if we go back into Tesla here and instead of regular trading hours, we also include the extended hours. There we go. You can see it's shaded. Okay. And again, I was looking back at Tuesday the 10th. There we are. Regular trading hours versus extended hours. So you'll see, look at this. The volume was relatively high. And then at 4 p.m., everybody turns off the lights and goes home. So you're basically getting very limited volume. As a matter of fact, there we go. We went from 300,000 contracts in 15 minutes to 20,000, 3,000, 8,000. I'm looking at the number in the top left corner right here for that. And you can see it's very, very light throughout the evening. And then we finally actually shut down completely at 8 p.m. and then reopen at 4 a.m. That's the electronic hours. Now, remember, in these shaded areas, the market makers can participate, but they are under no obligation when it comes to their quotes that they post or put out. So they can put some crazy quotes out there and they don't have to do anything about it. They can say they're trying to buy a million shares at $2, and it's just because they wanted to throw that in there and keep their spot active. That's it. But what happens before the market officially opens at 9:30 in the morning? Yeah, I'm trying to just cut this so we can see the volume. Now look at this. When I just look at after hours volume, notice where it starts to pick up. Sometimes it picks up a little early. You can see that 6 a.m. there was a big move in price and actually 10,000 contracts traded. But in general, the market makers start getting active and log in online right around 8 a.m. There we go. And historically, if you go back time after time after time and just look at the after hours, you'll see the volume picking up right around 8 a.m. And here's why. I mentioned the market makers have several different jobs, if you will, or reasons for trading. Okay, first of all, they're there. Let's change the color so we see this a little bit better. There we go. So the market makers, number one, to create liquidity, right? They are the buyer or seller of last resort. So if you put in an order to buy or sell something and nobody else is there to trade with you, they will step in and make the trade because they're trying to create liquidity. They're actually tasked with doing that. Often your orders don't actually get to the exchange. Let's be honest. If you're trading a stock, well, futures they will, but in a stock situation like this, typically your orders are getting filled with what's called an ECN or electronic communication network. If you're not familiar with what an ECN happens to be, it's kind of like, you have a mobile phone. The mobile phone is just a piece of technology, but it's worthless until you actually connect with a carrier, right? AT&T, T-Mobile, Verizon, whatever it may be. You have to connect to a carrier to be able to communicate. Same thing happens with the market. You have a brokerage account, it could be TradeStation, Thinkorswim, Tasty, it doesn't matter. You want to buy a stock, you don't actually send your order to the exchange. You have to use a carrier such as I can't remember now. It's been so long since I really thought about them, but there's quite a few of them out there. INET, well, it's not Instinet. There's a bunch of others. NASDAQ actually has their own. So there's ECNs that communicate your order, but sometimes those ECNs will match orders with other customers and fill your order before it even gets to the exchange. If it gets to the exchange because nobody in the ECN wants to buy or sell, the market makers may actually take the transaction to create that liquidity and keep the market moving. Okay, so they're creating liquidity, number one, but they're also there to fill customer orders. And you got to realize they have two types of customers: institutional and retail. Now, many of the orders, it's called ECN as in Nancy, Electronic Communication Network. Yeah, ECN. So they're there to fill customer orders. I mean, we saw some of these market makers in Tesla, Goldman Sachs, even right here, Bank of America Securities. If you're wondering why it says MLCO, that's because Bank of America took over Merrill Lynch and they're using them. Uh, Royal Bank of Canada, RBC, Key Bank. There's a lot of different brokerages out there. StoneX, as I mentioned before, they're a market maker and they do a lot of day trading through different brokerages. Citadel Securities, that's a big day trading prop firm market maker. And of course, TD Securities for Thinkorswim. And they actually have several different IDs. They took over Cowen. So anyway, whoops, where was I here? So they're there to fill customer orders. And then number three, above all, they're there to make money for the brokerage. They actually have trading capital and discretion to try to make trades and profit from the markets, obviously, just like we're trying to profit. And they've been doing this game for a while. They obviously have tons of experience and they know what they're doing. They do pretty well. Well, think about this. When the institutional retail orders come in, there's actually certain periods of the day that certain types of orders come in. And again, I did this. I was a trader for a brokerage and I was handling retail orders as well as institutional orders. And I was dealing with these market makers. So I know firsthand how it works. It's all done electronically, much faster now, much more automated, but it's still the same process. Your order has to go through an ECN to connect to the markets, and it may be filled in the ECN or sent to and filled by the market makers. So think about this. If you're a market maker and you're coming in, again, market makers, they start trading around 8 a.m. Eastern. So when they come in, there's a saying about the markets, and it's still pretty true. Amateurs open, pros close. That's talking about the order flow. Amateurs open, pros close. Usually a majority of the orders that are coming in first thing in the morning, the opening rush is from the novice traders, the amateurs, traders, retail traders who are putting in orders based on whatever they heard the night before, or they're actively day trading and they want to get in early, whatever it may be. Typically, these market makers would come into their office, and I did it too. You'd have this huge stack of orders. Again, it's electronic now, but we used to have these pieces of paper called chits that were written out by the brokers when they got the phone call from their customers. So I'd come in to, I would say there's a huge pile of chit on my desk to deal with every morning. My wife will roll her eyes when she hears me say that again, because I've said that way too many times. But, I joke, I said I had a shitty job, but somebody had to do it. But the thing is, there's a huge stack of orders. So let's imagine, if you will, that there's a huge amount of buy orders. Alex says, you're chitting me. Yeah, no, serious. Anyway, so just imagine if you have a huge buy order stack. And again, it's all electronic now, right? You still enjoy the joke hearing too many times anyway. Good. So if you have a huge buy order stack, you need sellers, right? Otherwise, you are going to have to become the seller. Now, market makers have a little bit different of a job, obviously, and they have some restrictions that are removed for them. If you wish to short a security, to short a stock, you have to borrow those shares and then sell them. Market makers don't have to do that. Market makers who are allowed to do what's called shorting naked. So they sit in their office with no clothes on. No, I'm kidding. They basically do not have to borrow securities to be able to sell short. They can actually sell short naked. It's part of as long as they're doing it as part of their job as a market making, creating liquidity, which is what they do. So here's the thing. They can find sellers, right? There's a huge buy order stack coming in because there's a lot of bullishness in that security from overnight. There's a lot of news in the company, or you just happen to come in. There's just a bunch of buy orders because the market's bullish and people want to buy. You need sellers. There's only two ways to find sellers. One, you sell, or you can push price up to supply. You can try to find a supply zone. Now, let me take a step back. I was talking about to become successful, you want to follow the big institutions who are very successful. Those big institutions, including the market makers, are trading typically during regular trading hours only. After hours, as you saw, the volume just drops off. I bring it, there it is, and there isn't a whole lot going on. So what happens is when I trade, and you'll see this in the E-mini think tank, in the lessons, I talk about trading using supply and demand, not support and resistance. It's a little bit different. What I'm looking for when I'm trading is to buy where the institutions buy and sell where the institutions sell. And what happens is when the way they trade in general, they leave footprints behind. They leave patterns that are observable in the markets. What we really need to look for when it comes to trading anything, it's not just stocks, but anything really, we need to find the origin of imbalance. You know, where are the buyers and sellers mismatched? Because what'll happen is that prices move because of that imbalance. Think about it. Why was there this big red candle pushing prices down? There's only one way that that can happen. There happens to be many aggressive sellers and a lack of buyers. Because if people were willing to buy, the sellers would just sell to them, the buyers would buy, and prices would go nowhere. They would just trade as much as possible at that same price level. But think about it. If you want to sell something and nobody's there to buy, the only way you can attract buyers is by lowering your offer and or ask, sell for less. And what happens? Prices start dropping until we find the buyers who are willing to take trades with us. Okay. You can't have a trade. You can't have anything showing on the chart unless there's a trade that occurs. So in this area, we see an imbalance. And basically, we're looking for the origin of the imbalance in this case. As a matter of fact, if you take a look at this, mark it off properly. And I'm not going to do the big wick way up there for now, but that's okay. You can see that this was an origin of imbalance where there was lots of selling pressure, but barely any buyers. So what happens when prices get back there again? Unless something fundamentally changes in the security, you're not likely to see a lot of sellers, a lot of buyers there again. And think about it. If you had bought here, how are you feeling down here? Not so great. As a matter of fact, when it gets back up there, you're more likely to become a seller if you had bought. That adds that selling pressure and adds to the imbalance. And look what happened here. We stalled out as we came back up. Now, this area, there's a big green candle. Why? Because there was a lot of buying pressure and nobody willing to sell. If you want to buy something and nobody's willing to sell to you, how do you attract buyers? You have to raise your prices, raise the bid, plain and simple. So the same thing happens here. We're looking for that origin of imbalance between buyers and sellers. This is where it all started, really right there, where that opened, and we ran up. We had lots of buyers, very few sellers. And therefore, think about it. If you sold here and prices rallied, you think you're going to want to sell there again? Probably not, right? So that's the origin of imbalance. Now, there's another little secret you got to learn about the markets, and that is what's called working the order. When institutions trade, they don't trade small amounts. They're trading millions of shares, at least hundreds of thousands of shares at a time. We're talking about leverage on top of millions of dollars or even billions of trading dollars. So there's going to be huge size being traded. The problem is when you look at what's called the time and sales. Let's see. Actually, let me log off of this real quick. Log back in. That way I can show you some more things. Hopefully. There we go. And apps. There we go. Market depth, for instance. Might take a moment for it to load. And while I'm at it, I'll close out one of the other pages. Come on now. Sorry, computer's running a little slow there. There's the market depth. And I want to close this page, close workspace. Note all. Do I think CL will make it to a Montreal station? I'm not sure what you mean by that. When I say supply and demand, are they supply the stock market, the underlying? No, it's just buyers and sellers. Yeah, the supply and demand of the buyers and sellers, basically. And here we go. Again, I'm using Tesla as an example. It really doesn't matter. It could be any security. Oh, going up to 125? I don't know. It could. I don't. It depends on what comes out of the Middle East and the news, basically. See, this is not enabled for the market depth, so I can't show you, unfortunately, that account. I probably should have stayed on the other account. And if I go to, let's see, do we have time and sales? There it is. Time and sales. There you go. Look at the number of trades and size being traded. There was 2,300 contracts, but most of these contracts are a few hundred at the most, right? Not contracts, but shares. Every now and then you get a bigger number, but very few. Yep. See, there was an over out of sequence too. That's a late print. Naughty, naughty. Anyway, there's a lot of games being played. Okay. But for the most part, you're seeing three digits every once in a while, four. So if I need to buy a couple million shares, it's not going to be done all at once. Okay. Wow. There's a lot of activity. Busted baskets too. Burst basket. Crazy. Anyway, I digress. But what's happening is that basically, when you are an institution, you want to buy or sell, you have to take your big order and break it into smaller pieces. Because think about it. If somebody like Warren Buffett decided they wanted to buy a couple million shares of a stock, once that gets announced, everybody's going to jump in and buy with them, right? Because they're trying to follow him. Or Nancy Pelosi, right? When they buy, everybody follows too because she makes lots of money in the markets. I'm not getting political. I'm just making jokes. But basically, or maybe not. Anyway, what happens is the big institutions don't want people knowing when they're big, jumping in big or jumping out of something big. So you do what's called work the order. You take those large size orders and you break them into smaller pieces. You can actually do that. Take a look. If you go into trade right here and you go into right here, the advanced orders, you can do this, show only. So if I decide I wanted to trade 10,000 shares of Tesla, I could show only 100 at a time and it'll auto refresh. It's called an iceberg order. And the institutions use these all the time to hide their true intentions. They may want to buy a million shares or even 10,000, but they don't want to show it because everybody will buy in front of them and it'll drive the prices up, especially when there's an imbalance going on there. Okay. The moving averages I use are not important right now, but it's 8 and 89. It's a strategy that I teach in the E-mini think tank. So yeah, you'll see I have right here 889 trading strategy. So it's a strategy I built like 17 years ago. I've been using it with high probabilities. So anyway, where was I here? Working the order. So you break your order into smaller pieces, okay? And that's what we're looking for, these footprints where there's institutional orders that likely drove prices up or down. And what'll happen is when prices return to that area, we're likely to see a repeat unless something fundamentally changes. So in this area, now, granted, this is overnight. I don't usually consider the overnight trading area or activity to be as important because that's not where the institutions are participating. This was at 6 a.m. If this occurred between 9:30 and 4 p.m. Eastern, I'd be more inclined to trade using that, knowing that it was probably a big institutional buy order who could not get all their orders filled. Therefore, there's likely to be leftovers when we come back. And we haven't come back to that point yet today. Well, let's see. Actually, it blew right through it. It could be the trend. Okay. But often, if this were done during regular trading hours, again, it was done after hours, so it's not as important. But if it was done during regular trading hours where you create that imbalance or origin of imbalance, for instance, here we have an area where prices pretty much went for a little pause. And notice it wasn't really huge volume to start off with, was it? The volume picked up as prices moved away. Why? Somebody was trying to sell here and there was nobody willing to buy, so they had to adjust their prices down pretty quickly. It's a larger red candle, and then we moved down. Well, there's a high probability if it was an institution, again, all we know are probabilities. That's all we trade. We never know 100%. That's why we use stop losses. But there's a high probability that because there was an imbalance and it originated there, there's also an imbalance that originated here. That if this were institutional trading, there's likely to be leftover orders, leftover sell orders in this case. And unless something fundamentally changed with this security, well, that was actually pre-market anyway. But if something fundamentally changes, yeah, we could end up seeing a lot of buying pressure there. But unless we see that, most likely, and when I say fundamentally, I'm talking about the trend changing. But most likely, there's still not going to be a lot of buyers in either one of those areas. Because think about it, if you bought here and prices went down, you lost. You're probably going to want to sell when it gets back there. And the institution that caused that move, because that imbalance of orders, is also trying to get the rest of their sell orders filled, right? And what happened? Prices went back to that area, but again, there was an imbalance. This is where all the selling orders were, and they pushed prices back down again. That's all we're trying to do is repeat by finding where the institutions bought and sold. Now, why does this matter when we're talking about gaps? Well, I'm glad you asked. Anyway, and that's why you're here, right? To figure that out. Well, as I mentioned, the market makers are going to be coming in around 8 a.m. before the market opens. So they're going to get their customer orders. And remember, they're not trading in a vacuum. The orders that one market maker receives is usually pretty similar to the orders that other market makers receive. So in the case of this day, let's see right here, that's Tuesday, we closed, and you could see pre-market, there wasn't a whole lot of activity going on. Pre-market is this pink area. And then at 8 a.m., just before 8 a.m., really, the volume started picking up, didn't it? See how the average volume is a bit higher here than it was in the past. That's because the market makers are trying to position themselves to fill customer orders. So what they're doing right now, it looks like they're pushing prices upwards. Why would they push prices upwards? Well, think about this. Remember, they have to fill customer orders. They're the buyer seller of last resort. So if they're buying right now, which is apparently what they're trying to do is push prices upwards, they may be buying now because their customers are trying to buy. Think about that. If they come in and the customers are trying to buy, in order for their customer orders, the buy orders to get filled, they need somebody to do what? They need someone to sell to them, right? Customers can't buy unless somebody sells. There's only two ways that they'll find sellers right here. Either they have to sell to the customers, or you push prices into a supply zone, that origin of imbalance, that will fill those orders for you. So what they're doing here, pre-market, what it looks like they're doing is the market makers are buying, because at the opening bell, they can sell to their customers. And if they bought here, they can sell to the customers at a higher price. And what happens? They make money for their brokerage, and they fill the orders. They created liquidity. They met all their three criteria. It's a game that happens on a regular basis. Now, what if they can't get all their orders filled? What if they can't buy enough to sell to their customers? They have extra sell orders. Well, when the market opens, or sorry, extra buy orders. When the market opens, they're going to have to get those filled whenever they can. And one of the games that they try to play is, as I said before, they'll look back to see where is there an origin of imbalance, and they'll push prices into that supply. So that way the supply zone, the imbalance will fill their customer orders. Looking back, that's a supply zone that was already used a little bit. So I'm not sure how good that's going to be. Let's see if there's any more back here. Hold on. Do you have this marked off for that? Yeah, I do, vertically. So I'm going to keep looking back to see if there's an overhead supply zone that has not been used. There we go. And now we have one, possibly. And again, this is what I teach in the mini think tank, how to identify the unused origin of imbalance. Here we can see, if I zoom in a little more, is an area where prices paused and then dropped dramatically. Again, origin of imbalance at 412. So what happened on the 11th? Go back. Where are we? 4th, 5th. I had to go back. I found a couple of zones just in case. Right? So here we are. 10th. Here's the overnight. And just before the open, 8:30, 45, 9, There we are. We moved up. We're not at a level supply yet, are we? Since we're not at a level supply, remember the market makers are buying, the customers are also going to try to buy, and the market makers can only buy so much before the market opens. If nobody wants to sell, they're kind of stuck. They may also just simply raise their bids. Remember, they're not obligated to actually buy pre-market. There may only be a few contracts being traded here. Now, 10,000, 7,000, or eight, really, 9,000. It's not a huge amount of volume, so they may not be able to get all the orders they needed filled. But they're trying to push prices close to an area where there's an imbalance. So the selling pressure will match the buying pressure from their customers in the morning, and it'll fill all those orders first thing. Plus, they're going to be selling their inventory to their customers. As again, double whammy, making extra money. Why not? So there's the open. And what happened? Again, imbalance obviously was a huge amount of buying pressure, and prices drove upwards. Remember, it couldn't satisfy this because this had already been tested. I mentioned that was a tested zone. So that means there wasn't as many sell orders left over because it had already been tested. This upper zone, however, had not been tested. And you can see prices ran right into that area and reversed. Not a surprise, is it? If you know what to look for. Basically, what will happen it used to be 15 minutes of the trading day, 15 to 45 minutes, technically. You move this back a little bit so we can see. Yeah, we're looking for that. Here's the origin of imbalance right there. In this case, we had lots of sellers, no buyers. The customers were trying to buy. Market makers are buying pre-market, but they couldn't get everything they needed. So when the market opens, all the buy orders from the customers are flooding into the market. Nobody's there to sell, or very few are, because remember, market makers can sell for a profit now. They bought pre-market down here, sell their customers at a markup, because that's legal, and they make a profit. And they get to charge you for doing it. Isn't that great? They charge you commission to rip you off. You paid for the right to get ripped off. Anyway, what happens now is prices rally into an area of supply. Now we have that imbalance that's getting filled. Prior to this, we had a huge imbalance with lots of selling pressure and no buyers. Those leftover orders from way, way back here, right there, are now getting filled by the customer buy orders this morning. It overshot it a little bit, but typically turns in that area. So what typically happens, again, you can't say always, but often in the first 15 to 45 minutes, that's amateur hour. 9:30 to 10:30, that's amateur hour, right? The novices are getting their orders filled. Opening are filling. And then what typically happens once the market makers have filled the orders, now here's another thing they might be doing as well. I didn't mention this. Right here, they were buying, and then here they were selling to the customers, right? Customers trying to buy, market makers sell to the customer. Now, if they couldn't sell enough, they'll sell short to the customer. Why would they want to sell short when they know prices are going up? Because they know those orders are going to run out at some point. And when the orders run out, once the orders are completely filled and satisfied, the market reverses. Because again, all the buying pressure is gone, and we're at the origin of imbalance of a lot of selling pressure. And the market makers may have been selling short. How do you sell short and make a profit? You have to have the prices go down, don't you? That's exactly what happens. You get that first reversal, and the market typically reverse. So the first 15 to 45 minutes, those orders, opening orders trying to get filled, those 15, 30, 45 minutes. In this case, Tesla is right on time. Then the market reverses. Once the market makers have made their profits, Because remember, they may have been selling short. They need to buy to cover. I should say close. They're basically making profits. They'll release the market into the trend. You will get another reversal. That's usually around 10:30 to 11 o'clock. So again, the first 15 minutes, 9:30 to 9:45, you usually get, sorry, 10 a.m. is usually the first reversal, about 30 minutes in the markets. This one was a little bit later. It was about, no, that was 10 a.m. right there, 10 a.m. to 10:15. So you get a 10 a.m. reversal, first 30 to 45 minutes, and then another reversal often at about 10:30. This one was a little bit late. This was actually 11:45. Now, with electronic trading, this could be sped up quite a bit, but often it still happens the same way. And you can see that they actually didn't have a good trend for the day. The markets just continued to sell off a little bit and eventually reverse at the end of the day. So it's not guaranteed to happen every time. The next day, what's going on here? Pre-market, 7:45. Whoops. Let's move forward here. There we go. And you can see this one, we closed here pre-market. There's some selling pressure coming in. So there may be a lot of selling going on from customers who lost money on the buying from the previous day. Oops. So now there's a bunch of sell orders the next morning. Well, in order to have sell orders filled, you need buyers, right? And where are those buyers going to come in? Either at an area of demand. So again, I can look back for an area of demand on my chart, or the market makers are selling short pre-market and they'll buy to cover for a profit and fill their customer sell orders. And what happens? There it is. First 15, 20, 30, 45 minutes of the day, those are the customer sell orders coming in. And the market makers who ended up shorting here before the market opens are buying to cover and filling those sell orders. So it's just the opposite of what we saw here on the gap up. The gap's down. Again, market makers, they have lots of customer sell orders pre-market, really for the market to open. So what are they going to do? They will sell short pre-market and buy to cover to fill the customer orders at the open. That's what they're doing. They're selling short here. And again, if we take out the after hours, or sorry, the regular hours, there it is. Look at the volume picking up. When does it pick up? About 7:45, 8 a.m. And then obviously 8:30 when there's news as well. But right there, before the market opens, the last 30 minutes or so, there's a big spike in volume. Why? The market makers are positioning themselves to get short naked so they can buy to cover and fill their customer sell orders so we can gap down. In the meantime, they're also trying to push prices down to the origin of imbalance as close as they can. Sometimes they get it right on the dot and the market opens and immediately fills the gap because they were able to open at an area of demand or an area of supply. If they're not, prices will run until it finds that turning point where we have exhausted all the customer orders. So in this case, opened up, prices ran down for the first 45 minutes, and now we've exhausted all the customer sell orders. Anybody who wasn't able to short and cover may have been going short. What does that mean? The market makers who went short now at the open of the market need to profit by, well, again, there's nothing to hold prices down if all the sell orders have been filled. So it'll rally up for a second reversal of the day. Oh, sorry, first reversal of the day. And in this case, it wasn't. We weren't at demand yet, so it just kept going a bit more. But there's a game that gets played pre-market with those orders. And it's not random that these gaps occur. Again, if I take out the extended trading hours and put just regular trading hours here, you'll see that a lot of these gaps will run directly into supply and demand areas. There's the supply that we ran into. Let's see, didn't really have much of a gap today, although you can see the gap this morning opened up just below a tested area of supply. And there might have been a whole bunch of sell orders still left over there. Customers got their orders filled, perhaps, and there's your reversal. So there's patterns that happen in the markets. And if you understand the rationale behind them and the market maker activity, again, it's all done electronically now. It's much, much faster, but the orders are still there. And they're still relatively predictable depending on how those gaps work. If I look at the Qs, for instance, same thing. Here we see a gap down. Okay. Prior to the gap down, there was probably a bunch of sell orders. We need buyers to fill those. Well, looking back, there happens to be an area of demand right here. Notice the origin of imbalance. Lots of buying pressure there. Well, the market makers couldn't gap it down far enough. They were probably short selling, and they're going to buy to cover from the, again, filling the customer's sell orders. And there's your first reversal of the day, trying to go back up. Once they closed out all their shorts, or filled out all the customer orders, they can release the market into the trend of the day. And again, it's just the game that's being played. Once you learn the rules of the game, and that's something, like I said, that we've been going through in the E-mini think tank, not just with lessons, but also, like I said, I've got these pictures and descriptions, kind of like what we were just doing. And we created trading plans for identifying not just where the gaps are going to be, but how to trade the gaps based on the style of gap they are. This is called gap play. And we have strategies based on that we trade on a regular basis. And it increases your odds for success in the markets if you have that idea of what's happening and know how to take advantage of it. So unfortunately, I got to get going pretty soon here because it's the end of our session, but hopefully I gave you some insight into how the gaps work, why they're happening. Again, they're not just random. They're happening because of order flow that's coming into the markets, and the market makers need to fill those customer orders as well as profit for the brokerage. So if you have more questions, by all means, try to ask those questions. If you have additional questions, either about the mini think tank program or about gaps, you can always email support@wealthbuildershq.com. Put the email there. And yeah, like I said, I think the link was put up a little while ago. If you go into the mini think tank link, you can actually check out all the education and everything for free. If you do the quarterly subscription, there's a 2-week free trial, and we don't charge it until after the 2-week free trial. It doesn't happen as quick anymore. It used to be, yeah, you would think it happens because everything's electronic, that would, the orders would get filled within the first few minutes or seconds. It still happens over time. It still takes a little while, even though there's things can trigger faster. There's still so much volume because what's happened is with the electronic age, we increase the amount of orders. Even though it happens faster, there's still a lot of orders to get through, and everything needs to be matched. You cannot have a trade without a buyer and a seller coming together. So it may take some time and or moving to the supply and demand zones to get those orders filled. Yeah. Orders are first come, first serve, depending on the type of order as well. Yes, price and type of order. We'll get the priorities. But and the nice thing is, I like to trade futures because with the futures, you're a little more level playing field. You don't have market makers. So it's not as many games being played as what you have in the equity markets. So that's another reason why I trade futures, plus the leverage, plus the taxation, and a whole bunch of other benefits as well. But anyway, thank you very much for being here, everyone. Hopefully, I'll see you again soon. Enjoy the rest of the trading day and trading week. And yeah, well, take care. Trade safe, trade well, everyone. Thank you for being here. Oh, thank you, Roman. Appreciate it.